OpenAI is projected to lose $150 billion by 2029, while being worth $500 billion before even going public on the stock market, and somehow investors are lining up to give them even more. In late 2015, a handful of Silicon Valley's brightest gathered around a single audacious idea. Artificial intelligence could be a force for good, if only its power stayed in the right hands. OpenAI was born not as a company, but as a non-profit research lab with a mission that sounded almost utopian: to develop artificial general intelligence that would benefit all of humanity, not just shareholders or governments. The founding team included Sam Altman, already known for his leadership at Y Combinator, and Greg Brockman, once Chief Technology Officer at Stripe. They were joined by Ilya Sutskever, a leading artificial intelligence researcher, and for a time Elon Musk, who pledged part of the original $1 billion in commitments. The charter they published laid out their promise in black and white. OpenAI would freely share its research, prioritize safety, and refuse to let profit or power dictate the direction of their work. The goal was to build advanced artificial intelligence in the open, publishing breakthroughs and code for the world to use. There would be no stock options, no initial public offering, and no backroom deals with tech giants. The only bottom line was the public good. OpenAI's early releases reflected that ethos. The lab published its code, datasets, and research papers without paywalls, attracting a global community of collaborators. The organization's structure was deliberately simple: no for-profit arm, no equity, just a tax-exempt nonprofit, governed by a board of directors tasked with keeping the mission on track. In those first years, the group focused on advancing the science, on language models, reinforcement learning, and robotics. Every milestone was shared with the world, not locked behind a paywall or a product launch. Yet even as the team chased breakthroughs, cracks began to show. The scale of their ambition demanded resources, more data, more compute, more talent than any nonprofit could easily marshal. The very promise that drew the world's attention also set the stage for a collision between idealism and the hard math of growth. In the beginning, though, OpenAI stood as a rare experiment, a tech lab run not for profit but for principle, holding itself to a higher standard than the industry around it. In 2019, OpenAI's leadership confronted a hard truth. The nonprofit model that powered their early breakthroughs couldn't bankroll the next chapter. Training ever larger models required compute and talent on a scale that dwarfed even their original billion-dollar pledge. The answer was a legal invention almost as ambitious as their mission: a capped profit limited partnership called OpenAI LP. This structure, announced in March 2019, let the nonprofit retain control while opening the door to outside investment. Investors could earn up to 100 times their money, but anything beyond that flowed back to the nonprofit, preserving the commitment to public benefit over private gain. The first major test of this new design came quickly. Microsoft stepped in with a $1 billion investment, securing preferential access to OpenAI's technology but no voting control. The deal was a watershed, signaling to Silicon Valley and Wall Street that OpenAI was now open for business, so long as the mission stayed on top. The nonprofit board, led by figures like Sam Altman and Greg Brockman, kept the ultimate veto over any decision that could threaten their vision for safe, widely shared artificial intelligence. But as OpenAI's ambitions grew, so did the friction. By 2024, the capped profit model was running up against its own limits. Investors wanted conventional equity, not bespoke legal arrangements. The prospect of raising tens of billions, let alone the hundreds, needed for projects like the $1.4 trillion Stargate data center plan became impossible without a more familiar structure. In December 2024, OpenAI announced plans to convert to a public benefit corporation, PBC, a hybrid that could issue real equity while pledging to uphold the nonprofit's mission. Regulators in California and Delaware demanded tweaks, worried that the new structure might loosen the nonprofit's grip. After months of negotiation, the final arrangement landed in October 2025. The OpenAI Foundation, a nonprofit, would hold a 26% stake and retain the power to appoint or remove board members at the for-profit OpenAI Group, now a PBC. Microsoft increased its stake to 27%, with the rest spread among employees and new investors. The profit cap was gone. It was replaced by the promise of nonprofit oversight, a compromise that unlocked the capital to chase AI at planetary scale, but left critics warning that mission and money were now on a collision course. ChatGPT didn't just break records, it shattered them. By late 2025, OpenAI's flagship product was serving more than 800 million people every week. That's more than double the population of the United States, logging in from classrooms, boardrooms, bedrooms, and factory floors. The growth curve looked less like a line and more like a rocket launch. 100 million users in 2 months, 500 million by spring 2025, and then in a matter of months, 800 million. Every day, millions turn to ChatGPT for answers, homework, code, business plans, and therapy sessions. The world's largest companies rushed to sign enterprise deals. Startups built entire products on OpenAI's API. Governments scrambled to understand the implications. The numbers were staggering. OpenAI's user base dwarfed that of Netflix, matched TikTok, and rivaled the combined reach of Google's most popular apps. In the span of a single year, the company vaulted from a niche research lab to a household name, its brand synonymous with artificial intelligence itself. For investors, this kind of scale was intoxicating. The company's valuation leaped from $157 billion to $300 billion, then to $500 billion, with talk of $830 billion and a $1 trillion IPO just over the horizon. In March 2025, OpenAI reportedly pulled off a $40 billion fundraising round, by far the largest in private tech history. But beneath the surface, the economics told a different story. Out of those 800 million users, only about 5% paid for anything at all. The vast majority used ChatGPT for free, burning through compute cycles that cost OpenAI dearly. The company spent roughly $2.25 for every dollar it earned, even at $200 a month. Pro subscribers did not cover their own costs. The more people who used ChatGPT, the more money OpenAI lost. In 2024, the company posted a $5 billion loss. By the first half of 2025, that number had ballooned to $13.5 billion. Projections showed cumulative losses through 2029 could reach $143 billion or more if nothing changed. The paradox was glaring. A product used by nearly 1 billion people, a brand climbing toward a $1 trillion valuation, and a business model that bled red ink at a historic rate. As capital poured in, so did the risks. OpenAI's ambitions stretched beyond chatbots, with plans for a $500 billion Stargate infrastructure project and a relentless push to dominate AI. Yet, the competitive landscape was shifting. Google's Gemini, Musk's Grok, and Anthropic's Claude were closing the gap, threatening to erode OpenAI's lead. Elon Musk himself, once a co-founder, reportedly tried to buy OpenAI for $97.4 billion and was turned down. The stakes were now measured in hundreds of billions. The question hovered over Silicon Valley and Wall Street alike. Was OpenAI building the greatest business bet in history, or the most expensive house of cards ever assembled? OpenAI's financials read less like a business plan and more like a dare. In 2024, the company lost $5 billion, burned through dollar by dollar on compute, research, and talent. By the first half of 2025, that loss did not just double, it exploded. $13.5 billion vanished in 6 months. For every dollar OpenAI brought in, it spent $2.25. The math is relentless, the loss is historic. The sheer scale is almost hard to process. 800 million people use ChatGPT every week, but only 5% pay for the privilege. The rest ride for free, each query stacking up more costs. Even the high rollers, those paying $200 a month for pro access, fail to cover their own weight. The infrastructure behind each answer, each line of code, each essay, is a black hole for cash. Compute alone eats up about 3/4 of every dollar earned. Salaries, stock grants, and research and development swallow the rest. The more OpenAI grows, the deeper the hole gets. The projections stretch the imagination. If nothing changes, cumulative losses could hit $143 billion by 2029. Some analysts peg it even higher. That is not just a red line, it is a canyon, one that no startup in any industry has ever crossed at this scale. For context, Amazon's legendary early losses were a rounding error next to these numbers. The cash burn is so aggressive that even the most optimistic revenue forecasts barely make a dent. OpenAI's business model, as it stands, is a machine that turns capital into compute, and then into more losses. The paradox is stark. The company's user base is larger than Netflix, its brand as recognizable as Google's. Valuations leap from $157 billion to $300 billion, then $500 billion, with talk of $830 billion and an IPO valued at $1 trillion. Investors poured in $40 billion in a single round, the largest private tech raise in history. And yet, the losses only accelerate. The Stargate project, a $500 billion infrastructure moonshot, looms on the horizon, promising even more capital outlay. Meanwhile, competitors close in. Google's Gemini, Musk's Grok, and Anthropic's Claude are racing to grab market share and drive up the cost of staying ahead. No matter how you slice it, the numbers are unforgiving. OpenAI's financial sinkhole grows wider with each passing quarter. The company is betting that scale, speed, and a few breakthrough monetization ideas will eventually flip the script. But with every billion spent, the question gets louder. Is this the boldest business gamble of the century, or the most expensive house of cards ever built? OpenAI's business model looks like the ultimate Silicon Valley paradox. Nearly 1 billion people rely on ChatGPT every week, but the vast majority never pay a cent. Out of 800 million users, only about 5% open their wallets for a subscription. The rest enjoy free, unlimited access, each prompt quietly piling up costs for OpenAI. The company's revenue engine is split between 3 pillars: consumer subscriptions, developer API access, and enterprise contracts. Subscriptions, ChatGPT Plus, Pro, and Team, bring in the lion's share, accounting for about 85% of revenue by mid-2024. API usage by startups and developers adds another 15%, while enterprise deals, though growing fast, remain a smaller slice of the pie. But scale, in this case, does not translate to profit. Even the highest-paying users, those shelling out $200 a month for Pro access, are not actually profitable. The infrastructure behind each answer, each line of code, is a relentless drain. Compute costs alone eat up nearly 3/4 of every dollar OpenAI earns. The rest vanishes into research, salaries, and stock grants. For every dollar that comes in, about $2.25 goes out. The more people use ChatGPT, the deeper the losses grow. Conversion rates drive the point home. Less than 1% of monthly active users pay for a premium tier. That leaves hundreds of millions using a product that, for OpenAI, is a financial black hole. The API business, once seen as a possible savior, has not scaled fast enough to offset the free user base. Enterprise contracts offer hope, but they are still chasing the breakneck pace of consumer growth. In pure numbers, OpenAI's business model is a bet that future monetization will someday catch up with runaway adoption. Until then, the company is locked in a race to scale faster than it burns through cash, a race that so far has no finish line in sight. OpenAI's valuation didn't just rise, it exploded. In just 18 months, the company's worth shot from $157 billion to $300 billion, then to $500 billion, as investors funneled in capital at a rate that outpaced even the wildest days of the dot-com boom. By March 2025, OpenAI had secured a $40 billion fundraising round, the largest private tech raise ever. These figures were not abstract, they signaled a new league, one previously occupied by giants like Apple and Microsoft. Sam Altman, OpenAI's driving force, matched the numbers with ambition. He unveiled Stargate, a $500 billion plan to build the world's most powerful AI supercomputer, describing it as a government-scale project. Altman's predictions grew bolder, including $200 billion in annual revenue, a $1 trillion IPO, and a future where OpenAI would be the era's defining company. The economics will follow, he assured investors, promising that scale would bring profit. Yet the optimism met resistance. Deutsche Bank analysts labeled OpenAI's losses unprecedented, warning that no startup in history has operated with losses approaching this scale. Projections suggested losses could reach $143 billion by 2029. Even premium subscriptions at $200 a month failed to cover costs, with only 5% of users paying. For every dollar earned, OpenAI spent $2.25. The more users flocked to ChatGPT, the deeper the financial hole. On one side, capital and confidence soared. On the other, a business model, bleeding cash, and a chorus of skeptics. As OpenAI chased a $1 trillion IPO and mapped out Stargate, the question sharpened. Was this the boldest bet in tech history or the most expensive house of cards? Gemini, Grok, and Claude are no longer distant threats. They are at OpenAI's doorstep, fighting for every user and contract. After the launch of Gemini 3 in late 2025, Google's grip tightened. Gemini's share of the AI chatbot market soared from under 15% to over 25% on mobile, while ChatGPT's app share fell below 50%. Web traffic told the same story. Gemini's site pulled in 2 billion monthly visits by early 2026, outpacing ChatGPT's growth and even surpassing it in some months. Grok, Elon Musk's answer to ChatGPT, surged from 1.6% to more than 15% of the app market in less than a year, feeding off X's massive user base. Meanwhile, Anthropic's Claude cut deep into the enterprise sector, winning multi-million-dollar contracts and securing a foothold in Fortune 500 boardrooms. The result? OpenAI's once dominant market share, which peaked at nearly 87%, now hovers between 45% and 68%, depending on the metric. The AI race is no longer a one-horse sprint. It is a full-blown brawl, and every lost percentage point means more pressure on OpenAI's already strained business model. Elon Musk, never one to sit quietly on the sidelines, made his move in the thick of OpenAI's meteoric rise. With his own AI startup Grok gaining ground and the battle for dominance heating up, Musk reportedly put $97.4 billion on the table to acquire OpenAI outright. The figure alone was staggering, nearly $100 billion for a company that, just a few years earlier, had been a non-profit research lab. But the board didn't blink. They turned Musk down flat, refusing to hand over the reins at any price. For OpenAI, it was a declaration: no billionaire, no matter how famous or how deep his pockets, would dictate the future of artificial intelligence. For Musk, it was a rare public rebuff. It was a reminder that, in the world of AI, even the boldest players can find themselves locked out. The message was clear. OpenAI's perceived value wasn't just sky high, it was untouchable. 800 million people rely on ChatGPT every week. OpenAI's losses run into the billions, about $5 billion in 2024, $13.5 billion in just the first half of 2025, and projections stretch to a staggering $143 billion by 2029. For every dollar the company brings in, it spends $2.25. Even those shelling out $200 a month for pro subscriptions do not pay their own way. Only 5% of users contribute a cent. And yet, the company's valuation leaps to $157 billion, $300 billion, $500 billion, with $830 billion and $1 trillion initial public offering in sight. Investors wired in $40 billion in a single round. Stargate, a $500 billion infrastructure moonshot, sits on the horizon. Rivals like Gemini, Grok, and Claude circle, chipping away at OpenAI's lead. Elon Musk's $97.4 billion takeover bid was turned away without hesitation. So the question stands: is OpenAI the boldest business gamble of the century or the most expensive house of cards ever built? 800 million users, $5 billion lost last year, $13 billion vanishing in just months, and a business burning $2.25 for every $1 earned. Even top-tier subscribers bleed red ink. Yet, OpenAI's valuation keeps vaulting. $157 billion, $300 billion, $500 billion, aiming for $830 billion, and a $40 billion fundraise fuels a $500 billion moonshot. The numbers defy gravity. So does the risk. Is this genius, or the most expensive illusion Silicon Valley has ever staged?